Hello, welcome back. My name is Dr. George Mochocki. Today we'll be talking about Chapter 4, Time Value of Money and Cash Flow Streams. We discussed in Chapter 3, we talked about streams of money, and now we're going to go on. This one's going to be not a very long discussion. We'll have this, and I'll give you the tools to work at. It's an extension of what we did in Chapter 3, only now we're going to break it down into perpetuals and annuities. So when I look at the difference between the two, we'll just discuss it. It's just a cash flow. Remember, everything in finance and net present value. What is the value of the money now going to be worth in the future? So if I put money away, how much am I going to need in the future? So I'm saving. So companies have to do this planning ahead of time. And what you're going to find out with this chapter is going to give you the mechanism, the mechanical tools, the math formulas to do this. I'm not going to go into all the formulas. I'm just going to give you a conceptual idea of what to do. Yeah, I only got 20 minutes, but I'm going to go back into Blackboard. I'm going to go back into my finance lab at the beginning just to show you where all your information, so you'll be able to understand this. Remember, you kind of understand it from chapter 3. This is just now, how do I do it forever? That means I get a steady cash flow coming in. If you're people that are retired and you look at their IRAs, they get a continual stream of income coming in. Now, companies use the stream of income in different investments, either in annuities or perpetualities, is basically so they could basically know that every month I've got this bill covered. I got something coming in, okay? So, but how much is going to work? How much do I need to have in the future? Because I know with inflation and everything else, the value of that dollar is going to take more dollars to buy the same amount. I mean, historically, you could have a reset. If you have a big crash in the system, when I talk about a finance reset, it goes back down to zero and it starts all over, building it up. You know what I mean? When it's going to, for lack of better words, uh, hit its point, and then it resets itself back. And you'll understand after we finish the course. I'm just trying to throw in a little information so you see what's going on. Okay, so now I'm going to go into our Blackboard. Okay, so I'm into Blackboard, and we're going to go into my finance lab that Pearson has, and also the book. Remember, you're looking at the book, good book. It has in here. You're going to be utilizing here the calculator. Now, if you haven't purchased a calculator, this calculator right here. If you haven't purchased it, it's a nice calculator. You go buy a car, you buy interest rate, you look at your mortgage, you look at the future value, you look at your annuities, your IRA. You could solve this right here. It has all the formulas in here. So, but if you don't have it, the book in my finance lab will basically have the electronic version of this, so you could kind of look at it and follow the book along. It has, for lack of better words, let me see, I have it in here. And all of this is just the mechanics, the math portion to it. And it tells you exactly how to do it, step by step. I'll just let you see it. You know what I'm talking about when you're looking at it? It tells you what button to press, and you follow along. For the homework assignments and the exams, I'm only going to go on the first level. This is a community college. I'm not going to go way up here. I'm just going to get you a kind of exposed to it. I want you more to understand the concept. What the heck is going on? Remember, finance is all about taking my money. Do I build something now, or do I do it in the future? And how much is going to cost me in the future? And I'm making an assumption. It's not like I have a crystal ball. I have historical data. I have different trends. I have different models, different software that kind of gives me an idea. But still, it's up to me to make that decision. So companies need money for cash flow, to pay their bills, to pay their employees, or to pay their bonds, or debt that they owe, or other things, or new projects. But how do I have this stream of income that kind of will level me out, so I know I'm kind of taken care of going it's kind of like a risk management, for lack of better words, in finance. So I know I've got a certain amount of money at least to cover the majority of what my expenses are going to be in the future if I plan this right. And remember, anytime with annuities or perpetuality, you basically could make those adjustments as you go on. All right, because things happen. So you're doing your best guess now. Hopefully you'll work for 5, 6 years, and then you might have to make a little tweak, or something else goes on. and then you have to make those adjustments. That's part of life. That's part of business. You have to be flexible. You have to have your finger always looking around, see what's going on the financial aspect. Right now, a lot of companies are shifting because of the trade war we have with China, for lack of a better word. That could be solved. I don't know, but right now they're shifting the production to Mexico. So what's this Trump administration doing? They're also looking about migration flow coming in here. So they're going to say, you got to slow it down. You let them in your country, they're pouring in here. We're going to start putting a tariff on you. Now the company is going, oh no, we just got out of China. We're moving our production to Mexico. Now there's a tariff war between the U.S. and Mexico. It's going to hurt more the Mexican economy than our economy because we're always the buyer. You have to understand, we buy the stuff, so they're the suppliers. But they said, could we go to Vietnam? Could we buy our products from Brazil or other countries that make similar products, or be able to move the production in there because the tariff isn't there? The tariff is a tax added on to my logistics, my chain supply, for lack of a better word. That cost has to be incorporated because if I have a cost for material and I'm planning on this through my streams of income, money coming in, and I only have so many customers or anything else, how am I going to make my adjustment? And that's what's going on. All right? Interesting finance. It's beautiful. Look, don't be afraid to go, oh my God, everything's going wrong. It's in everyday life. Your car breaks down, this breaks down, I need this money, how do I do this? And you will use your creativity and understanding finance. How do I use the money in short term or long term? So right now, when we're looking at cash flows, we're trying to get a stream of income, at least a steady income coming in the long term. And then I do the adjustment. If I need more, I add more or do something. But I don't have to come up with the full base amount to pay a certain debt or finance a certain capital project that I'm looking forward to. Okay, so let's go back in here. Remember, you're going to go into your you're into Blackboard, or you got the link in there, or you could go directly to my finance lab, and you're going to come in here. Hang on a second. I just want to remind you because we're just starting off. Because as we go forward, the concepts get a little more complicated. The math portion is, well, it seems like I'm getting a headache. I understand that. Don't worry. I just want you to know conceptually, and I'm giving you the easy problems just so you kind of see the mechanics and how they come up with these numbers. Okay? Okay, so you're going to come in here, and you're going to come in here. So we're going to go Pearson, chapter resources. Okay, I'll click on that one. That's a good one. What the heck? Oop, pop-up ads. Okay, so I go to chapter resources, and I go to chapter 4. Okay, so you got your homework. It helps you with your homework. It has videos to help you out. It has animations to talk you through it. It has a spreadsheet. It has your grade book. Okay, let's look at the videos, what they have on here. Okay, so here's what you can do. You select your calculator. It has a calculator. You have the web chapter. You have your animation, real short. You have your spreadsheets. Those ones use the spreadsheets because once you start doing these long-term numbers, there's no way in heck you're going to do it by hand. You either everything's down the road. Halfway through, you're going to start doing spreadsheets, and it just makes it easy because the numbers are so repetitious, going over and over this month and next month. You're multiplying. You'll have errors. Let the system do it for you. Okay, and an annuity calculator. Okay, a market versus book value. Wrong chapter. Oh, geez. Let me go in here, chapter 4. Okay, so I just select all and see what they have. Okay, fine. Now, this way you know what you have. You have your calculator, and it'll walk you through. Let's see what it has on here. Look in the compound. It says John invested so much money. All right, then you start. You go to the next one, and it tells you how to do it. Zero. Make sure you don't forget this. Okay. Now step 2. That's what the value is now. Right? Just put 10. You don't have to do a percentage because the interest rate it already does it for you. Don't put anything else. Just put the 10 in there. You'll be fine. Okay. So that's a number. Okay. So far, so good. I couldn't have done it better.
Press the compute button and then the future value button to solve for the future value of the lump sum.
So there you have it. All right, simple as pie. Let me see if I could just do this without messing up. Okay, so I'm just going to close this out. All right, so you have that one. Now you're looking at the future value of an annuity. Let me just go on this one.
Ellen is 35 years old and she has decided it is time to plan seriously for her
Look,
retirement.
these tools I'm showing
If
you are here
Ellen
for
is
you.
65 years old, she will save $10,000 in a retirement account. If the account earns 10% per year, how much will Ellen have saved at age 65?
And some companies will put money away so to have the project. They're not going to do the project in 10 to 20 years. How do I build on a smaller amount and pay the compound interest over where I invest my money and I have a stream of income? Either I collect it or I reinvest it back into it. So I never see that money. It just grows. That's basically what your IRA is doing or your retirement. Okay, so it's going to go with the
Step
calculator.
1. Press the reset button to clear all the previous entries.
Make sure you always press that reset button.
Step 2. Enter the number of periods, in this case 30, and then press the end button.
Now this
Step
one's
3. Enter the periodic interest rate, in this case 10%, and then press the interest rate button.
okay. Now on this calculator, this is a financial calculator. But if you're using the BA2 Plus, you have to do it. It doesn't have a reset button. You basically have to do clear twice. Okay. And in the book, you'll use this one or the other one. All right. This is the financial calculator, the electronic version that they have. So it's not. It's kind of combined, makes it easier instead of doing the two-step process. I just want to bring that up. So you're going to have clear here, and then you do a second in function and clear over there. Okay. And then we talked about that earlier. I just want to remember remind us. This is just as easy if you're looking at that. Okay, so next one.
Step 4. Enter the annuity amount per period, in this case 10%, and then press the payment button.
Okay, are we all right?
Step 5. Press the compute button and then the future value button to solve for the future value of the annuity.
And there you have it. Does that kind of make sense? Remember, this is negative because it's in the future. This is how much money's going on, and you will discount it back later. Don't worry about that. Just follow the steps on this. Okay, so we're good on this. Okay, so we have that. Now you have video. So this tells you how to use the calculator to solve the problem. Now if I'm going to do present value cash flow, here's the video. It's going to show you how to do the math. Let me make it a little bigger. Hit it.
Okay. So you want to buy a new car. Luckily, you have a rich uncle who's willing to lend you the money.
It's only
Now
one
you're
minute. It's
paying
not too long.
$5,000 a year from now and then $8,000 per year 3 years after that. The question is, how
Now this is going to
is
be, remember, some of the income you have is not going to be steady.
uncle
You have different money coming
doesn't
at different
lend you the
times.
money? Then his other option is to put it into a well, the answer is the present value of the cash flows that you're going to pay Uncle Henry. So let's put the cash flows we would pay Uncle Henry on the timeline. To find out how much money we can spend on a car, we simply take the present value of these cash flows. We take the present value of the first cash flow, discounted for 1 year at 6%, the second cash flow, discounted 2 years at 6%, the third cash flow, discounted 3 years at 6%, and the fourth cash flow, discounted 4 years at 6%. Adding that up, we get a total of $24,890.
All right. So let me just get out of this one here. And that. Okay, that's all I want to do. So you got the videos to help you out. Now, when you get in your homework assignments, I'll go 4-2, 4-3. I do it exactly by the book. Follow the book. Look at the video. Some of you've got a laptop and desktop. I usually have one here. That's the way I usually like learning. I'll see the video and I'll do it. I'll look back and forth. You'll be able to do it. Or you look at it, stop, pause, and get to understand. Remember, you got double screen. Most of our computers, easy. Utilize this to your advantage. Okay, so we have that. So I'm gonna let me just close that off. Now we're back into my mind map. Now my mind map. Remember, What you're learning in this chapter here is cash flow. I have to have so much cash to maintain my business. I want to at least have a majority. Most of us, look, we put away so much money, and then something that comes up and down, we can make the adjustment. So if you got a certain stream of income coming in of money, guaranteed, because I put so much money away, or to build a project, or some money that I have to pay some of my debt. A lot of retirees, that's what they do. They live off of this. You know, they got mortgage, all this, and every month they have this, and that interest just they take out that interest, but it keeps on generating, keeps on coming back on the compound interest. So what you're looking at, but how much is the value? You know, my the what do you call it? The wages are going up. I mean, we're in Illinois, right? They're going to have they passed the 15 minimum wage law, so $15 an hour wage requirement that I have to pay all my employees. Okay, but I think it's a gradual. It works its way up. I haven't looked at the actual bill signing yet. You know, until they sign it, then I'll worry about it. But a lot of people already voiced their opinion. So if I'm anticipating the next 3 years, I got to pay $15 an hour. How am I going to get that cash? If do I raise my rates, or do I have extra money? Right now, I'm looking at, okay, maybe it may go in 15, maybe not. So I have a cash flow to be able to pay my employees at $10 an hour. Okay, so I got to make up that other $5 an hour. I may make an adjustment, or I may say, okay, I could just raise the rates here. But I have my tools. Remember, when you look in finance, you're looking at what's going on now and in the future, and I want to at least have some money, some different flows of income. When you look at finance, I just saw most of us we only get one paycheck. In finance, I get a paycheck here. I got a different market. I got money coming in here. I got accounts receivable. I got money invested in here. I got a project. I got bonds that I owe on, or I've got IOUs, or I got something that I'm selling or renting. So that's different streams of income. All those streams of income, that's what you do with the finance. How do I manipulate them and utilize them to my benefit? Okay, so valuing cash flow streams of income. Remember, most businesses fail because they don't have enough cash flow. They've got all this investment, but they can't pay the daily bills. If you can't pay your bills, all of a sudden you're a higher risk. If you're higher risk, you got to pay higher for when you take out a loan. If you need some or a line of credit, your supplier is going to say, "Hey, he's always paying me late, so I'm going to charge him a little bit more to offset it." Understand that. You know, I'm not going to give him 30 days. I'm going to give him 20 days to pay because I don't trust him. I don't want to get stuck with it. So all this because of cash, I don't have enough to pay my bill. So what I want to do is have different streams of income. I've got money to manipulate, but which ones could I do to anticipate in the future? When we go into the future market, basically when people buy oil in the future and lock it in on the price, we'll talk about that a little bit later. You already had it in accounting. They're trying to lock in the price, so even if the oil goes up, they could have a flat operating expenses. Sometimes the oil prices go down, and they're stuck with that higher price. Hey, that's the gamble of finance. That's the gamble, the risk you're taking. But you have to be able to see what's going on, and overall, you're keeping the company solvent, and you're having that cash to pay your bills. Okay, so that's all it is value, cash. And when they say streams, there's different streams. Here's the math portion. We talked about that. Here's the calculator, and you got the electronic calculator. We just discussed that. Okay, perpetuate is basically a stream of equal cash flows. All every month, I get the same amount coming in, and they last forever. Just because compound interest, so money comes in, and it keeps on paying on the interest. And here's what my cash is worth. That's how much money I'm coming in. But inflation is what is the value of that money? What could I buy with that money in the future? Look, when I was a kid, for 25 cents, I always bring that up in the class. I get a big bag of candy. Now for 25 cents, I get one little gumball. So remember, even though I got the same cash coming in, inflation and different market forces, environmental forces, will either bring up the price of certain commodities, or bring them down. If it brings it down, that's good. I got more money to spend. All right, similar. Okay. All right, so you have that. It arrives at the first period. Okay, now annuities. The only difference between this and perpetuities, and I pronounced that a little wrong. English second language, so some of the words I mispronounced. People know me. That's fine. Are you all right? Don't worry about it. Try to speak Polish, or a lot of you speak different languages, and it's hard to twist the tongue. I understand the concept. Worry about the concept. Okay, it's a difference between the two cash flows. Well, the only difference is on this one. This one, an annuity has an end date. It ends at a certain time. Boom, it ends. Okay, so then I could work. I gotta. I don't want to spend the money for my ad blocker. Okay, so two types of cash flows. You got the present value as makes the first payment from today, lottery prize annuity. Look, when you win that $20 billion, why do they want an annuities? They don't have to have it. They may only have to have like 5 million in there to make it up to pay it out over the time because it's basically compounding on that. So they pay you out every year over 20 years, and so they don't have to have the amount. Some people want the full amount, but then you're going to be taxed more unless you invest it. And there's look at the rules, all right? But there's something to look at. Okay, now the future value, basically, here's the thing. So now I'm looking at here's what it is now, my present value, and my future value is here, and then I discounted it back to make sure it's working. So you're looking at the stream of income. But remember, it's only one little section of your finance. Don't think, here's how much money I'll be all right. Now, a lot of people are retired and they expected to live maybe to 60, 65. Now they're living to 95 because of the medical. So the money they had to 65, I mean, let's say they retired at 60 and they live to 70, they're already set. I'm okay. But now I'm living 20 years more, and now the inflation and then the cost of everything else is going up. So now they're working at Walmart. Nothing wrong with Walmart. They're working at a side job to offset that, to assist that stream of income. They got the money's coming in, but it's not enough. Remember, because the future value is more, and there was no adjustment. So even if you have your retirement, you have to look at the adjustment. What's the interest rate's been flat for a while? If they go up, how high they're going to go up? And that's the fun of business. But you always have to have your thoughts. You always have to be focused on what's going on. Okay. So now we've got this, and this one here is growing the cash flow, and this one here is just again, it's just a stream of cash flow is just the mechanics of it, the math portion. Walk you through it. If the calculator helps you out, solving cash flows is basically the rate of return that you expect on that. Is it going to go up? Is it going to go down? And you make your adjustments. Remember, in finance, you're always making adjustments. Same thing you have to do in your own personal life. You make adjustments depending on what's going on. The gasoline prices go up. What happened? Right now they're stable. Oh, $3. I got to have the big car. They go up. Oh shoot! I got to buy a little car now to give me better fuel mileage. I don't drive as much. I plan my trip. And think of that as in your own personal life what a finance manager has to do for an organization. And he has thousands of employees. He has operations in different countries. He has to look at the exchange rate. He has to look at the cash flow. And so he has different monies coming in, but he has to be able, like a musician, to tune it so it works well. So when he goes and needs the money, he has enough. He doesn't have to go out scrambling. He's taken care of. Okay, so this chapter. It's an interesting chapter. It's short. I think that's let me just go in here. Expand level one. So we covered this. It's just an extension. Don't get too freaked out. But I want you to start using. Remember, in my finance lab, look at it. Stop. Take your time in the classroom. I talk quickly, and you go, well, "What the heck he said? I don't understand a word he's saying." Here, you could take step by step, and you'll understand it. All right, and you'll know it. You won't be an expert. Don't worry. So read the book. The book gets a little bit more complicated. Some people are going to be challenged. You will be challenged. But remember, I want you more to understand conceptually what's going on. The math part is the mechanics to make sure that those numbers make sense. You're talking about, so you're using the numbers to justify your strategic plan, your financial plan, and to say, hey, it worked. And the numbers are there. Numbers don't lie. It depends how you put them in there. Numbers don't lie. At least you have a good idea how much money I'll have by that time. But I don't know those external forces. What's going to happen in the environment? Are we going to be in a war? Are we going to be in a depression? Are we going to be hyperinflation? All that stuff could affect that cash flow, how much money. If you look at Venezuela, socialist country, right? What happened? They didn't plan. They only had everything on oil. Oil prices went down. Now all of a sudden, what happened? People, for a lot of money, exchange rate, you got this much dollars stacked up just basically to do what? to basically buy a loaf of bread. So they don't even count them anymore. Just weigh it because it takes too much time to get the loaf of bread. It's poor planning from a country. So let's see what happens. All right, whether you like this administration or not, he's trying to make it better for us. Remember, I'm looking at a business perspective from what the Trump administration is doing. He's looking at the country, how to make us strong going forward. We have the cash. We got more. We don't owe everybody. We're like a debtor nation, for lack of better words. We owe everybody. How do I reduce my payments? So now, remember, when you have money tied up in credit cards, when you have money tied up in debt, that's money that you lose for opportunities. I can't buy this thing. I can't get this new venture because I got to pay off my debt. And that's the same thing that happened in Venezuela as a country. They had to pay off all that debt. And it would have been all right if everything was constant. But life is not constant. It goes up and down. They didn't have any backup. Saudi Arabia or some of the Middle Eastern countries, their oil's drained. There's only so much oil in the ground. So what are they doing? They're diversifying. They're trying to do maybe entertainment, bring something else in so they have another stream of cash coming in. So all this last two chapters about cash flow, how to make money, how to prepare and have streams of income coming down as an automatic mechanism, for lack of a better word. So you do find, just understand that everything about finances, look into present value and look at the future value and kind of make the assumption that I have enough money in the future to take care of my needs for the organization as it grows. Okay, or I have to make my adjustments going forward. Let's see how many minutes I got here. Hopefully I'm under 20. Okay, 26, we're good. All right, and because I showed you some videos in there, I'm encouraging you to use the videos. Very easy. It's done professionally, step by step, and you'll understand it. And the homework problems, you follow the book, you follow the homework problems. The exams, you follow the book, follow the homework at this level. This is a community college. I want you just to understand conceptually what's going on. I am to expose you to these terminologies and the mechanism of the math portion, how to solve it. I just don't want you. You can put it all in a spreadsheet, calculate. Here's the number. Well, the future values. That makes sense. Oh, I put in 1,000. Now I got 30,000, or a certain interest in 10, 15 years. But will that 30,000 buy the same thing now as it would in the future, or do I buy now or in the future? And we're going to go into that later on in other chapters. Remember, now we're just talking about concepts. Stream of income means different money coming into the business from different operations or different investments that I have. All right, again, my name is Dr. Jordan Mochocki, and enjoyed having you in class. Look at this. It's not that hard. You'll understand at this level. I try to bring it down, make it as easy, as simple, so you understand conceptually what's going on. Have a nice day.